And welcome to Chapter 12. Today we'll be discussing macroeconomic and industry analysis. So I think this will be a really helpful chapter. When we talk about certain industries, we have information technology and software within that. We have industrials and builders or military equipment within that. You have consumer staples and companies like food staples like consumer staples. I'm sorry, like General Mills. Very interesting stuff. And then healthcare, you have stuff like pharmacies and health insurance companies like CVS. So I think this will be an interesting chapter. And then I'll probably tie in this week's project cases with the particular industry. So taking the work we've been doing and just bringing it, one step deeper in terms of depth of our analysis, which, hopefully you guys enjoy. And I am just waiting for this to load up for us. So here we are, macroeconomic and industry analysis. Global economy. What is the national economic environment? Crucial determinant of industry performance. So one thing that's done pretty well recently is consumer staples. Why is consumer staples done well? Is during times of economic turbulence, our consumption of cereal or dog food does not change all that much. And the reason I mentioned cereal and dog food, it's really because I was thinking about General Mills, classic consumer staple. If anything, you could make the case that consumption of dog food and cereal is increasing from previous levels and not only just stabilizing. Also, exchange rate matters. If your currency has gotten cheaper or more expensive relative to other foreign currencies, that can have a significant impact on goods and even potentially inflation. And here's just showing exchange rates. And differences and changes over a period of time. From 2003 to 2013, we really saw, for the most part, the dollar get stronger relative to international currencies. Even today in 2020, we've seen the US dollar before the pandemic increase in value relative to foreign currencies. That trend has recently reversed. The reason it's reversed is because effectively it is viewed that we will have to spend more stimulus on the economy than other countries because of our handling of coronavirus, and therefore it will weaken our currency to a higher degree. That's not necessarily a bad thing. When we weaken our currency, that means our exports are cheaper for foreigners, and imports become more expensive for us. GDP, gross domestic product. You guys have probably seen this before. It's that's the market value of goods and services produced over a period of time. You may have seen something that GDP increased on an annualized rate of 33% last quarter. First of all, that number that they gave is not really accurate because we saw a dramatic increase from that downturn that we experienced, number one. And number two, we wouldn't expect that recovery to remain at that pace, right? That quick reopening pace. So, it'll be interesting to see where GDP falls for this year. And I say falls because it's likely going to shrink. Unemployment rate, we're very familiar with that. The unemployment rate only measures the unemployed within the people who are willing and able to work. Retired people, children, it does not include them in that number. Next, inflation. That's the rate at which general prices for goods and services are rising. There's no perfect measure, perfect basket, but things like rent, the cost of food, things like that. But, as your personal basket differs from the average basket, your personal inflation rate can vary. One thing I mentioned to people is that, in my life, I did a lot of eating out. So for me, kind of less eating out and switching to the grocery store is a tremendous reduction in cost. On the other hand, if you were someone who just always went to the grocery store, you've seen a pretty significant increase in your grocery prices. Interest rates. Interest rates are set by the Fed in the US and other central banks across the world. That has an impact on what financing will cost. If we view inflation is too high and the economy is running too hot, the Fed will raise rates to prevent the economy from overheating and potentially inflation getting out of control. If we want to stimulate the economy, the Fed will reduce interest rates, making the cost of borrowing cheaper, allow people to refinance at lower rates. Next, budget deficit. Consumer spending in excess of government revenues. Most governments, especially the US, do operate in a deficit. And then sentiment. How does the consumer feel? So that will certainly change with the mood of the country, whether it's with politics or wealth or perception of health, right, in this environment. So we saw sentiment increase on the vaccine. But we haven't even experienced that vaccine. The market and the sentiment are up on the belief of that vaccine. Fundamental factors of interest rates. So supply of funds from savers, demand of funds from borrowers, the government's net demand for funds. So what is the government doing? And then the expected inflation rate. Next, determination of equilibrium real interest rate. And this is just a repetition of what I just talked about. This is just showing a theoretical and academic. As the demand for money increases, the demand for money, if that increases, interest rates will rise. Interest rates are how we measure the expensiveness or cheapness of money. If we see interest rates going up, money's gotten more expensive. If we see interest rates going down, money is cheaper. If people demand less of our money, then that will drive interest rates lower. If people are demanding our dollars, that will keep rates high. Demand shock, event that affects demand for goods and services in the economy. Supply shock, event that influences production and costs in the economy. I would say that really the financial crisis was a supply shock, while coronavirus and 9/11 were demand shocks. Fiscal policy, that is something you're going to hear about more and more, because after the government has eased monetary policy, the second bullet point, lowered interest rates, made it easier for people to borrow. The fiscal policy is tax and spending. So what do we want the government to do in environments like that from an investment standpoint? We want effectively governments to really step up, and maybe some classic road and bridge projects, right? Get blue collar workers working, things of that nature. And then supply side policies, address productive capacity of economy, goals to induce workers, owners to produce more goods. So supply side policies could be, once the economy is doing better, you can reduce unemployment benefits. And that will get people off unemployment because they feel poorer on unemployment, and they'll feel richer going back to work. So that's an example of a supply side policy. Business cycles, those are recurring cycles of recession and recovery. Peak is when you hit the top of the market. So think about like January, right before everything crashed. And even right now, we're kind of hitting another top. And then trough is the low point. So most recently, this was this past March when the market really hit a bottom on concerns of, the economy closing and COVID. And here's a visualization of this data, right? The peak, the contraction, then it hits a bottom, and then it expands. Cyclical industries, industries with above average sensitivity to the state of the economy. So here's a cyclical business, the manufacturing of RVs, or the manufacturing of boats, even the manufacturing of cars. Those are very cyclical businesses. Defensive businesses, as I mentioned, you could have utilities, but you also could have General Mills, as I mentioned. That would be defensive, right? We expect that to kind of be stable through thick and thin. Economic theories that tend to rise or fall in advance of the rest of the economy. So if you see average weekly hours being reduced, these are, if you were tracking this as an economist, what would you look for as signs of strength or signs of weakness? Are people working more or less hours? Are people filing for more unemployment claims? Are companies making new orders? Is the aggregate supply index increasing or decreasing? Are new orders for capital goods going up or down? That's a sign of kind of business confidence. If corporations are making big purchases, then maybe it's safe for you to do so as well. The yield spread. The yield spread shows the difference between risky debt and risk-free debt. During periods of turbulence, the difference between risk-free debt and risky debt is big. But during, the bull markets, it's small. The reason why it's small is like when the good times are rolling, no one's going bankrupt. So the difference you'd pay for a risky company and a risk-free company becomes small. But then those widen when the economy sees some turbulence. Next, new housing permits. If you see new housing permits increasing, that could be a sign of health. Stock prices, money growth rate, and then other business expectations surveys. So, and the hard part is usually they're not all going in one direction, and otherwise everyone would know it, right? So you look at these in aggregate. Right now, we have increasing unemployment claims, but we also have new home growth, right? Maybe the housing market is what saves the economy here. Employees, how do you tell economic theories that tend to rise or fall in tandem with the rest of the economy? So these aren't predictors. These are kind of like live looks, and that's payrolls, income, industrial production, and sales. And then here's an index of consumer sentiment. You can obviously see that if you matched the stock market up with this, the periods when sentiment was the lowest was usually an opportunity to buy. I would say when sentiment is high, you would sell, but even with high sentiment, strong sentiment can persist for years. It's the negative sentiment that tends to be fairly brief. Even in 2008, there was only really low sentiment for about a year and a half. This one's, they tend to rise or fall behind the rest of the economy. So average length of employment, ratio of trade inventories, inventory to sales, change in the cost of labor, change in interest rates. Like the Fed will be reactive generally, and they'll lower rates after the crash has occurred, right? Ratio of credit card payments outstanding, and then CPI changes. And there's an economic calendar. An economic calendar will tell you when a whole series of these data points will be released. Defining an industry. So NAICS codes, the classification of firms into industry groups, using numerical codes to identify the industries. This is for most of the computer software I use. I'm not entering a number code. I know the industries I look at definitely have codes associated with them. But for my daily work, I actually look more at the sectors, which is one level above the industries when I'm managing a portfolio. But the industries are an example of that. Within information technology sector, an industry could be software or it could be microchips. Both of those fall into technology. Ironically, Google and Facebook don't fall into technology. They actually fall into communications. And Amazon does not fall into technology. Amazon actually falls into consumer discretionary, which is kind of like where people spend extra cash. Here are the different codes for different industries, home building, things like that. Return on equity. What is the return on equity? So it depends on where you look and when you start. They measured this in 2017 after airlines had a really healthy run. I'm sure if you looked at ROE for airlines now, it's not nearly as robust. Biotech, surprisingly very low return on equity. That's because biotech is filled with home runs and wild misses, right? And then here's some stock performance on average. This is the return in 2013. So you can see that airlines had a great year. And this is, again, looking at different software firms, return on equity. And return on equity doesn't mean anything. It's one single data point. It's not the be all end all. It doesn't mean Oracle is better than Adobe. In fact, if you go back to 2017, Adobe has done tremendously better than Oracle. So the return on equity is a single data point. This is showing the cyclicality of groceries versus jewelry, right? We see here in 09, no one's buying jewelry, we're all broke, right? Same thing in 2001. But during the boom years, right, jewelry sales massively exceed groceries. Sector rotation, right? One thing I was doing, probably the last 3 months in a lot of client portfolios was making sure I was fully exposed to banks. So what does fully exposed to banks mean? Fully exposed to banks, let me just tell you, I'm going to pull up my little chart here. Fully exposed to banks is about a 10% weight in financials. I was rotating out of technology stocks that have gone up and bank stocks that had done poorly. And I was trying to get a little bit more defensive and take profits where I'd received them and go into more defensive industries. Also during the pandemic, I added to CVS because, I'm like, hey, CVS, healthcare, vitamins, pharmaceuticals, they probably won't close. It'll benefit. We see here, this is a great visualization, healthcare, staples, utilities, financials. And then on the expansion, technology, depending on where you are, consumer discretionary, materials, and industrials, right? Another example of an industrial would be Boeing, or another company I look at is called Builder, BLDR. They make home building equipment, but within industrials. A company that makes equipment for building homes is an industrial's name. A company that actually builds single family homes is actually in consumer discretionary. Inside consumer discretionary, I would say that's the broadest category, because if you think about what's in consumer discretionary, here's some sample names: Sony, Amazon, home builders, The Gap, Home Depot. It's very broad. Anything that consumers really will willingly spend their money on. Different industries have different life cycles. So right now, energy is only about 3% of the benchmark. Most of my portfolios don't contain any energy stocks, mostly because, if I'm trying to beat the S&P 500, the S&P 500 is only 3% energy. So how many names am I going to own? Maybe one. You don't win a lot for owning energy. Plus, I look at energy as in secular decline. We're going to use more or less oil 10 years from now. I don't think we're going to be ramping up into highway traffic or crowded planes and air travel anytime soon. So, that's another risk. And this is going to showing the, industry growth cycle. And what happens towards the end with minimal negative growth, you see the industry is mature, the competition has become too tough, and then we start to compete on price. And when we compete on price, everyone starts to lose. Porter's 5 forces: threat of new entrants, bargaining power of buyers, threat of substitutes, bargaining power of suppliers, and then rivalry among existing competitors. These are kind of a foundation when looking at a business. Is it a good business? See how it checks off the box of these things. So let's just use Bunker Hill as a quick example. Threat of new entrants. I'm not worried about anyone competing against Bunker Hill. Why? Because we already can beat them on price, and the market in Boston is already full of colleges. Bargaining power of buyers. Well, you guys have little bargaining power because Bunker Hill's already cheap. Can't negotiate anything further down. Bargaining power of suppliers. The school books and stuff like that. Bunker Hill doesn't have to. They can use anything they want. No one can force them to use a certain textbook. Threat of substitute. Right? Threat of substitute is going to be low because, again, in some ways because of the cost, right? But rivalry among existing competitors, there might be where Bunker Hill loses the most ground if we're looking at a Porter's 5 forces. Why? Because, we do have so many options. If you want to pay more, you can get more, right? So when we look at the competitive advantages. And then this is an appendix for the economic calendar. So that's great. So that's it for chapter 12, guys. So I will be posting this up and letting you guys review these slides. And I'll be posting some new cases for us this week. And please feel free to always ask me questions. Let me know if you have any questions about the market. I'm happy to answer.